Welcome back to the channel, y'all. The IRS 1031 exchange. Maybe you've never heard of it, or maybe you really just want to dive in and learn some more about it. Either way, I've got you covered. I'm going to break it down for you right here today. I'm going to teach you everything there is to know about 1031 exchanges and the IRS 1031 exchange rules. So just in case you're new to 1031 exchanges, let's start from the very top. What is a 1031 exchange? How does it work? What are the benefits of a 1031 exchange? Okay, first things first, a 1031 exchange or a like-kind exchange is a method of exchanging investment properties that allows you to defer capital gains tax. Did you notice I said investment properties? This is referred to by its namesake, the IRS Code Section 1031. Now, this bill was passed in 1921 to encourage active reinvestment by giving investors the ability to avoid taxation of ongoing investment properties. The primary benefit of a 1031 exchange is obviously tax deferment. Now, with a 1031 exchange, you can defer taxes on the investment properties you own indefinitely until you sell, exchanging from one property to another. When you consider what this allows you to do, it opens up a whole section of added benefits, such as these three things. First, let's talk about an exchange for market conditions. For example, let's say you're worried about another housing bubble. You can take some of your Class C properties and exchange them for a more stable Class A property. Now, this will help you weather the storm. This would be the same way a stock investor might shift investments from live stocks to the S&P. Now, with a 1031 exchange, you're able to move your investment capital around in a way that will minimize your risk. So let's talk about an exchange to minimize upkeep. Now, you could shift some of your Class C or D properties to lower maintenance Class A or Class B properties if the upkeep's just too much for you. And third, let's talk about an exchange to take advantage of a developing area. You could shift your properties from one location to a more desirable or more promising location to position your properties for bigger future returns. Now, the great part of that is there's no limit on how often or how many exchanges you can do. You can continue to shift your investment capital around to maximize returns and create your own ideal portfolio. So let me explain the 1031 exchange rules. A 1031 exchange is really pretty straightforward. If you own investment or business properties, you can exchange it with a like-kind property to defer capital gains tax if you follow the rules. Now, it's really important to understand the 1031 exchange rules and requirements before doing one on any property that you own. Now, let's talk about the rules. Property needs to be a like-kind property. It must be the same taxpayer. The property needs to be an investment or business property. The property must be of equal or greater value, and you must follow the 1031 exchange timeline. These are the same 1031 exchange rules for California and Texas and New York and Florida or any of the other 50 states you might own properties. So really, no matter where you are, these rules are really important to know. Now, each one of these could use some explanation, so I'm going to break them down real quickly without too many boring statistics. So first, it needs to be a like-kind property. So to do a 1031 exchange, the new property you're purchasing needs to be a like-kind property, the one you're selling. According to the IRS.gov website, a like-kind property must be of the same nature, character, even if they differ in grade or quality. I know, I can hear you and I agree, that's pretty darn vague. These rules are really pretty generous. Number one, both properties must be used for the same purpose, which essentially means you can make the case that any two investment or business properties are like-kind. You can even relinquish one property in exchange for two properties, and in some cases, for example, a rental in exchange for two commercial properties or a beach house and a small 6 to 8 unit apartment complex. Number two, the second rule, it needs to be the same taxpayer. Now, this might seem obvious to you, but it really is worth noting. In a 1031 exchange, both the property being sold or exchanged and the property being bought needs to be purchased by the same party. This is important, y'all. If the names on the sale property and the exchange property are different, it's not going to be accepted. Number 3. Now, the third rule, it needs to be an investment or business property. There was previously a loophole that allowed the use of personal property in some cases, but due to recent changes with the 1031 exchange law, that's no longer the case. So according to the IRS, Section 1031 now applies only to the exchanges of real property and not exchanges of personal or intangible property. I want you to keep in mind that this rule really goes both ways. You can't sell a personal residence to purchase an investment property or a new warehouse or a building for your business, and you can't sell an investment property or a business property to purchase a personal property. Number 4. Now, this fourth rule, the property must be equal or greater value. This one isn't a full requirement, but it will eat at your tax deferment and essentially nullify the whole purpose of the exchange. So in order to qualify for 100% tax deferment, the net market value of the property you're purchasing has to be equal or greater value than the one you're selling. Now, here's an example of an exchange that would qualify for 100% deferment. The property you're selling is worth about $950,000 and the property you're purchasing is $1,110,000. Now, here's an example of one that wouldn't work. The property you're selling is $715,000 and the property you're purchasing is $510,000. So do you see that? In the second example, the one you're buying is less than the one you're selling, so it wouldn't apply for that tax deferment. It really is important to note that this applies to the mortgage as well. Both the value of the property and the mortgage on the property you're looking to purchase must be equal or greater than the value and the mortgage on the property you're selling. So for example, the 100% tax deferment, the property you're selling, it could be $750,000 value and your mortgage is $500,000. And then the property you're purchasing is $810,000 and the mortgage is going to be $650,000. So the value of the property that you're purchasing is more than your exchange property. Y'all, the mortgage is higher than the value and the mortgage of the one you're selling. Now, here's where it wouldn't apply. Let's say the value of the house you're selling is $750,000 and the mortgage is $500,000. And the property you're purchasing is greater than the value, $810,000, but the mortgage is less at $450,000. So even though the value of the house is more, the mortgage is less. So it won't be 100% tax deferment. I just want to make sure that you understand these rules. I'm just going to touch on this in the next rule, but you can qualify for an exchange even if the value or the mortgage on the new property is less than the original sale property. And a helpful note, fees such as broker, inspection fees, they all apply here. So make sure you include them all in your calculation for the most accurate estimate. So then there's this thing called a boot. This is what happens when the value of the property that you're buying is less than the one you're selling. You pay the capital gain tax immediately at purchase on the boot amount. So for example, the property you're selling is $1,250,000. And the property you're buying is $1 million. $1 million. So the one you're buying is less than the one you're selling. The boot would be $250,000. So you're going to pay capital gains on the $250,000, but the capital gains are going to be deferred on that $1 million purchase value. Rule number 5. It must follow the 1031 exchange timeline. So one of the more confusing aspects of the whole process is the 1031 exchange time. So let me make it crystal clear here for you. From the moment you close on the for sale property, the timeline begins. That's day 1. From day 1, you have 45 days to choose 3 potential replacement properties. They must be qualifying like-kind exchange candidates. So I want you to keep in mind, you're not choosing one right now. You just need to have 3 candidates or 3 potential properties selected. I know what you're thinking, so what if you change your mind? If you change your mind later and decide not to select one of your original 3 candidates, you will incur your capital gains tax and essentially nullify the major benefit of the exchange. So I want you to be really careful about choosing these 3 candidates. Now, there's one more exception to this. Now, this rule is called the 200% rule. If you're having difficulty deciding between just 3, you are allowed to select additional candidates. The only 1031 exchange rule of this is the total value of those replacement candidates must not exceed 200% of the value of the original property which you sold. So now that you've selected your candidates, the final 135 days and the exchange timeline are reserved for finalizing the purchase of the new property. You see, by the end of the 180-day window, the exchange should be completed to qualify for the 100% tax deferment. So now you know the 5 rules. Let's move on to who qualifies for a 1031 exchange. The qualifying parties are pretty all-inclusive. You can do a 1031 exchange if you are a property owner or an investor, own a business property, and to be more specific, you can perform a 1031 exchange if you're an individual, a C Corp, an S Corp, a partnership, a general or limited, an LLC, a trust, or any other tax-paying entity. Now, I just want to go back and clarify what property qualifies for a like-kind exchange. Earlier, we touched on the like-kind exchanges, but you might still be a bit unclear as to exactly what qualifies as a like-kind exchange. So let's just dive into that just a little bit deeper with some examples for you. A like-kind property is defined as a property of the same nature, character, or class. And note, the quality and grade don't matter with regards to like-kind property. So for example, you could exchange a small office building for a small apartment complex, or vacant land, or a larger office building. All of those would qualify as like-kind exchanges because they need only one of the same nature, character, or class. Now, there's one major exception to this, particularly for the property managers overseas or investors overseas. Properties outside the U.S. will never be like-kind to U.S. property, which only makes sense given that the 1031 is a U.S. tax code. Okay, so now I want to explore the types of 1031 exchanges. There's actually 4 different kinds of 1031 exchanges. We've got a deferred or a delayed exchange. We've got a simultaneous exchange. We've got a reverse exchange and a construction or improvement exchange. So let's break down each one and go over some of the pros and cons of each type of exchange. First, let's talk about the deferred exchange. By far, this is probably the most common type of 1031 exchange. It is probably the one people are most familiar with when you hear that word 1031 exchange. Now, we have a deferred or delayed exchange, and a deferred, or sometimes called delayed exchange, the time between the sale of your current property and the purchase of a new property are separate from one another. Once the sale closes, you have 180 days to hire a qualified intermediary to initiate the sale and hold the funds in a trust to be used to purchase the like-kind property, to select an exchange property, and to purchase the new property. Number 2, simultaneous exchange. The second kind is a simultaneous exchange. In a simultaneous exchange, the property you're selling or exchanging and the property you're having or you're buying close on the same day. Now, this, as opposed to a deferred exchange, this one doesn't offer much flexibility. And let me tell you, it can be difficult to pull off. There are so many moving parts to a real estate transaction. Even a teeny tiny small delay in this process on either side can throw everything off. There are 3 ways a simultaneous exchange can be performed. First, a qualified intermediary. Here you can also hire a qualified intermediary to handle the entire process. Take the stress off your back. Here, a third party other than a qualified intermediary manages the whole process. And third, you can use a deed swap. And an exchange of deeds, essentially a trade, happens when the other party who is simultaneously purchasing your property and selling one of theirs. The third kind is a reverse exchange. Now, in a reverse or a forward exchange, things are flipped on their head. First, you purchase a new property, then you sell the old property, often referred to as the relinquished property. Now, I want you to really keep this in mind. To do a reverse exchange, all cash is required for the purchase of the new property. In this type of exchange, the deferred exchange, but the reverse, you have 180 days to sell the old relinquished property. If you don't, the exchange is canceled and you're due for all the taxes. Between the purchase of the new property and the sale of the old one, the property is literally parked. Now, once the old property is sold, the proceeds are forwarded by an intermediary, typically through a trust, and the exchange is complete. Number 4. Now, this fourth kind is a construction exchange. In this final type of exchange, a construction or an improvement exchange, you have the flexibility to perform improvements using the equity from the sale of the exchange property. Now, please listen. The only caveat to that is there are a few 1031 exchange rules that you've got to follow. All of the equity from the sale must be spent on improvements or as a down payment during the purchase of the new property by the 180th day of the exchange process. Now, you as a buyer must receive substantially the same property of that which you identified by the 45th day of the exchange process, and improvements must be completed before the title can be transferred over to you. There are some special cases to be aware of when it comes to doing a 1031 exchange too. In most cases, they may not apply to you. I think it's worth making yourself aware of them, just in the rare case that it might apply. So 1031 exchanges on vacation homes. In the past, the law was more lenient in terms of what you could do with a vacation home via 1031 exchange. Since 2004, the restrictions have been put in place. However, it's still possible to turn a vacation home into a rental and then 1031 exchange it. For example, let's say you have a summer home that you've stopped using, so you decide to transform it into a rental. There aren't any exact time periods, but as long as you have tenants in the property for at least 6 months, preferably a year, a 1031 exchange is generally considered safe. Now, I want to clarify, this has to be the time with active tenants, not just up for rent. There really should be actual tenants in the property. That's the key. So the longer the tenant lease, the better. Okay, so what if you decide you'd like to convert one of your 1031 exchange properties to your primary residence? You can do it without incurring the wrath of your deferred capital gain tax. So there are some caveats. First, in 2008, the IRS ruling set forth a safe harbor rule that states you must meet these 2 rules within each of the first 2 years immediately following the exchange for it to maintain its classification as an investment property. Now, first, the unit must be rented to another person for a fair rental value for a minimum of 14 days. You can't use the unit for personal use for greater than 14 days or 10% of the number of days during the said 12-month period that the unit was rented out. In other words, it's generally safest to rent the property out upon a 1031 exchange for 2 years before converting it into your personal residence. Now, if you have any plans of selling that primary residence within 5 years of that exchange, you won't be shielded by the primary residence capital gains tax break. So I want you to consider carefully what your plans are for the property, whether you plan on using it long term or at least beyond 5 years or later exchanging it or not. Next thing is we're going to talk about is called tenancy in common. Tenancy in common gives you the ability to invest and obtain fractional ownership in a much larger property with up to 35 total investors. This offers several benefits, including the ability to obtain a stake in a much larger investment property than you'd probably otherwise be able to do on your own, the ability to diversify your holdings or consolidate those holdings. But it's important to remember that when using a tenancy in common, you have the same rights as a full owner. That means you can sell your portion of the property at any time, so as long you can be accredited by meeting certain financial requirements. So how do you report a 1031 exchange on taxes? IRS Form 8824 is used to report a 1031 exchange on your taxes. You want to be sure to file it for the year the exchange occurred. Some of the information you're going to need is dates when the property was identified and transferred, the value of the property received, property descriptions, any possible relationship between the two parties involved in the exchange, cash received or paid, an adjustable basis of like-kind property sold or relinquished. I hope you're still with me. The last thing to talk about is the 1031 exchanges and estate planning. One of the greatest long-term benefits of using 1031 exchange as real estate investing is the ability to completely erase the deferred debt upon inheritance of the property. When a property is inherited through a 1031 exchange, meaning the property was acquired at some point in time using a 1031 exchange, the value of the property is upgraded to fair market value and the tax debt is erased. Now, I want you to always make sure you consult with an estate planner. Make sure you're following the 1031 IRS exchange rules correctly. You really want to make sure that the right steps are put in place. There are several details that, if not followed, can really invalidate the entire process. A 1031 exchange is an amazing tool that should be used wisely. After all, you really don't want to mess with the IRS. But when utilized properly, a 1031 exchange can elevate the performance of an investment property and give incredible flexibility on a lot of levels. You really want to make sure to consult with a qualified intermediary before you begin the process, especially if it's your first exchange, to make sure you have all the right pieces in place. And finally, here's a huge disclaimer. The materials and information I've given you in this video are for informational purposes only and not for the purpose of providing tax or legal advice. You should contact your attorney and/or accountant, estate planner, to obtain advice with respect to any particular issue, questions, or problems. Whew! Now that I got that out of the way, I hope that I was really able to break down the 1031 exchange and all the requirements, all the rules, and all the ways it can benefit you. And if it did help you better understand the process even a little bit, make sure you give the video a huge thumbs up and subscribe for more helpful tips and tricks. Did you know this is the #1 place for everything you need to know about how to live, work, and play on Galveston Bay? Reach out to me or my team and we'll make your Gulf Coast move a smooth one. Until then, I'll see you on the next one.